Welcome to This Explainer. Today, we're diving right into a really controversial, fiercely debated thesis, the predicted 2027 housing correction, and a highly specific liquidity playbook that claims to be the best way to survive it. Whether you're a homeowner, an investor, or you just love keeping tabs on the markets, the source material we're unpacking presents a fascinating, heavily data-driven perspective on exactly where real estate might be heading in the very near future.
But first, we actually have to challenge some serious conventional wisdom. I mean, for generations, we've all been told that a primary residence is the ultimate financial safe haven, right? The absolute bedrock of middle-class wealth. Well, the authors of this thesis pose a pretty provocative question. Is your home equity actually a trap? To understand why the source material emphatically says yes, we need to look closely at the macroeconomic warning signs flashing right now and explore the structural cracks in our current property valuations. Okay, here's our roadmap for the breakdown. First up, the 2026 supply shock. Second, the home equity myth. Third, the 2027 waterfall collapse. Then we'll cover the aggressive liquidity shield, and finally, executing the vulture strategy.
Let's get right into it. Section 1, the 2026 supply shock.
The thesis argues that a severe correction is brewing, born directly from an unprecedented flood of inventory. And they point to three major converging factors creating this shock right now. First, we are seeing a historical surge in multifamily unit completions hitting the rental and buyer markets all at once, which fundamentally alters the baseline for housing availability. Second, you have the silver tsunami. Aging demographics are actively starting to sell off their larger, traditional family homes to downsize. But third, and this is a big one, the authors assert that the psychological dams holding back those pandemic-era mortgage locks are finally breaking. Homeowners who felt permanently anchored by their sub-3% rates are running into an unavoidable life events. Divorces, sudden job relocations, growing families. They are being forced to move. And it's unlocking a massive shadow inventory that's been artificially kept off the market for years.
When you look at the sheer raw scale of this mid-2026 inventory surge, wow, historical inventory spikes don't even come close. The thesis signals that we are at the exact critical moment where buyer exhaustion meets peak inventory. Buyers are stretched to the absolute breaking point by affordability constraints, high borrowing costs, and incredibly tight lending standards, right at the exact moment a tidal wave of properties hits the open market. It's a classic supply and demand mismatch, just magnified on a scale we haven't seen before. The authors suggest this extreme imbalance is the spark needed to ignite a widespread market correction.
Which brings us to Section 2. The home equity myth. So with that massive supply shock building, why do so many homeowners feel totally safe right now? Well, the authors point to the psychological reliance on paper wealth. Sure, you check your home's estimated valuation online in 2026 and you feel financially secure, but the source highlights the harsh underlying reality of diminishing returns. Homeowners are getting absolutely crushed by escalating maintenance costs, skyrocketing insurance premiums, which have literally doubled in some regional markets, and super aggressive property tax hikes based on inflated past assessments. The thesis argues that owners are just looking at their gross equity and feeling fine, completely missing the fact that non-recoverable holding costs are actively eating away at their actual net worth, month after month.
The core premise here is a bit of a wake-up call. When a broad, systemic downward trend begins, that perceived safety net actually locks you in. Think about it. Paper wealth in a primary residence becomes a totally illiquid trap during a correction. You can't just carve off a piece of your roof to buy groceries, or pay a medical bill, or pivot into better assets without either selling the whole house or taking on expensive, high-interest debt. According to the thesis, when property prices decouple from economic reality and start falling, that illiquidity turns what we usually call a prime asset into a very heavy, immovable anchor. That leads right into Section 3, the 2027 waterfall collapse.
If we look back at previous cycles, the source notes that 2008 was a drawn-out, multi-year bleed driven by subprime contagion. 2022? That was a sudden, freezing interest rate shock. But the projection for 2027 is fundamentally different. The thesis argues that 2027 will be significantly faster and deeper. Why? Because of modern instantaneous information flow, algorithmic pricing models used by institutional buyers, and just the sheer volume of new inventory hitting all at once. The authors project this devaluation timeline will be severely compressed. We aren't looking at a slow bleed. We're positioned for a rapid repricing event.
This hyper-accelerated timeline is driven by what the source calls the waterfall effect. Basically, it's a domino scenario. Over-leveraged investors are forced to sell,
which triggers a broader, extremely rapid price collapse. When everyday homeowners suddenly see institutional investors and highly leveraged retail landlords frantically dumping properties at a steep discount just to stop the bleeding, panic sets in. That psychological panic prompts regular owners to list their homes immediately to capture whatever equity is left. That forces even more inventory onto the market, driving prices down even faster in this cascading, uncontainable waterfall.
But what actually triggers that very first wave of investor panic? Well, the thesis draws a direct correlation between rising macroeconomic unemployment projections for the upcoming year and a sharp, inevitable dip in rental income stability. As unemployment ticks up across key sectors, everyday renters struggle to make rent. Vacancies and evictions spike. Suddenly, that consistent cash flow that over-leveraged investors completely rely on just vanishes. Without that rental stability, they can't cover their high-interest variable rate debts. The data concludes this specific cash crunch is what will force them to liquidate immediately into a market that's already saturated.
So, how do you protect yourself? Section 4. The Aggressive Liquidity Shield.
If a waterfall collapse of this magnitude really is on the horizon, the strategy offers a very explicit defense mechanism. It relies entirely on liquid cash. The thesis states quite plainly, aggressive liquidity is the ultimate defensive posture when asset prices decouple from reality. By moving to cash, you're buying optionality. You keep the strategic freedom to pivot and deploy capital on your own terms, while the rest of the market is locked into depreciating 30-year liabilities. When everyone else is scrambling for the exits and those exits are clogged, cash lets you sit safely on the sidelines, totally insulated from the downward momentum.
And there's a historical precedent for this. The source points to a highly specific window. 18 months. Historically, that is the exact duration where high-yield cash equivalents have proven to completely outperform during the initial volatile phases of a housing correction. While real estate and equities are violently thrashing around trying to find a bottom, high-yield cash doesn't just protect your principal from the crash, it actually generates a safe, predictable return right in the middle of the macroeconomic storm. To actually pull this off, the playbook outlines a highly disciplined transition. Step 1, honestly and aggressively evaluate your real estate-heavy portfolios to identify vulnerabilities, especially properties with really thin cash flow margins. Step 2, start transitioning those illiquid assets into high-liquidity shields, things like short-term treasury bills, high-yield savings accounts, or ultra-safe money market funds. And Step 3, complete this transition before the current year ends. The authors really emphasize that the whole key to this defense is beating the rush to the exits before the 2027 waterfall officially accelerates and liquidity dries up completely.
Which brings us to the final phase. Section 5. Executing the vulture strategy.
Because holding cash isn't just about hiding in a bunker, right? It's about strategic preparation. The ultimate goal here is what they call the vulture strategy. The author's advice is to use your cash reserves to acquire distressed assets at the absolute bottom of the 2027 cycle. This details exactly when you should stop saving and start aggressively deploying capital back into the market. By preserving your buying power during the crash, you position yourself to swoop in and acquire deeply discounted real estate from those over-leveraged folks who are forced to sell. The source frames this as far more than just survival. They see it as turning a painful systemic crisis into a rare, once-in-a-generation wealth-building opportunity.
Based on the incredibly compelling data and the highly structured thesis we've looked at today, we all have to take an objective look at our own financial posture. The source leaves us with one incredibly stark choice regarding this predicted market shift. When the 2027 waterfall begins, will you be holding the depreciating asset or will you be holding the cash? It's a massive, provocative question that really demands we look closely at our own portfolios. Thank you so much for joining me on this explainer, and I highly encourage you to dive into the source data yourself to decide on your own strategy moving forward.